It's time for the Your Personal Bank Show with Ferenc Toth, president and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. We've got an exciting day here. We've got a lot of great stuff to cover. We've been covering a lot of great stuff on our previous shows, too. So really would encourage you, if you haven't heard or want to go back, go to Your Personal Bank, yourpersonalbank.com. And you'll see on the front page and all the previously recorded shows, and you can in the topics on what have we've been covering, and check it out. We also have an app, Your Personal Bank. Your Personal Bank. Yeah, it's just Your Personal Bank. Sorry, the app, and you can listen to download that for free, and you listen to that on your phone. So check it out for previous information, or you want to find out more about what we've been talking about. Today, I'm really going to cover a couple of new product enhancements that are really exciting. They're game changers, okay? And also a major problem I want to cover that I see investors make is, as a financial person the last 22 years, I see this commonly made, unfortunately, far too common. I just worked with a client this last week, ran into it again. So I just want to bring that up and how to avoid that and eliminate one of the biggest mistakes I see investors make. And then, of course, always keep in mind, we always talk about thinking like a banker versus an investor. I'm the chairman of the board of a bank in formation currently. So, coming from quite a credible source, if you know what I'm trying to say. So what is your personal bank? Well, you're creating an asset that is guaranteed and insured. You have access to your capital basically right away, majority of it. You can earn interest on the asset and the borrowed funds. We're going to go into that in further depth, because that is really key and the key powerful point in operating like a bank instead of an investor. Of course, if you set up this correctly, you can create income tax-free growth and access those funds income tax-free. We can show you how to do that, okay? And again, the tool that we use, it's really quite simple. It's not commonly known, but we use a very specific type of insurance tool. It's a high cash value tool, not something most people are familiar with. This is the type of tool most commonly, is far commonly used with corporations, banks, large investors, high-income earners, executives, those kinds of things. It's commonly used in that world, and that's why you don't see it as often in the average American, if you know what I'm trying to say. So it's not commonly known by the typical investor or advisor, for that matter, and it's very much of a specialty type of thing. I get asked this all the time, why doesn't my person, why I haven't run into this? Well, unless you're dealing with like corporate boards, executive compensation committees, you're on the board of a bank like I am, those kinds of things, you're just not going to run into this concept or this financial tool. It's just not going to happen. It's not in your wheelhouse. You're not familiar with it. You may have heard of it, but it's not something you would be familiar with. Just like in any other career arena, if something you're not dealing with on a regular basis, you may have heard of it, but you're not familiar with, certainly you're not going to be an expert on it. It's not something you're going to share with others, most likely, or promote it or any other way. I've been fortunate. I've been introduced to that world. I work in that world, and I just I'm bringing that world to pretty much everybody. And so I'm doing something that's kind of unusual in that regard. So it's kind of exciting. I have fun with it, okay? So again, teaching people how the wealthy operate and how they think about money. It's a fun thing to do. Now, the tool, like I said, why do we use it? Compound interest. We want our money to grow every year. We don't want any risk of loss. You don't want to access funds or borrow funds from an account or an investment that can lose money or lose value. That is a recipe for disaster. I think everyone pretty much agrees with that. You want liquidity. You want access to your funds, majority of them, right away, if need be. So, what should I say? Annuities, CDs, some annuities, I should say, and CDs have safety, but they don't have that anywhere near that kind of liquidity. You want to have access to your funds. You don't want to have any, tax penalties or other restrictions eliminating or preventing you from accessing your money. So, and then the last thing is you want to be able to grow your money income tax-free and access it income tax-free. And if you set it up properly and work it properly, you can do that. Again, my biggest challenge, when I say insurance, some people turn off. They stop listening. They think of insurance as an expense versus an asset. They think of the home and the car and all those other things, and they think, oh, great, the last thing I need is another bill. Guess what? That's not what I'm talking about here. It's completely different. Should you have those things? Of course. You need those things. But again, this is a high cash value tool. It's designed to grow cash. And the best way to understand this is most life insurance contracts, you can look this up online, research it. We know this. They're mostly death benefit protection tools. You're paying the minimum premium for the maximum death benefit. Some may have a little cash involved, but they're not designed to grow cash. That's not their purpose. And I'm talking about the vast majority of life insurance contracts out there. So when you research life insurance as an investment, you get, well, it's not a good investment. Well, of course not. It's not designed to be one. It's designed to be a death benefit protection tool. Now, what's the difference? Here's the difference. If you can picture in your mind for a second a teeter-totter. Put on one side of the teeter-totter cash, and the other side death benefit. Most contracts, most insurance contracts, like I said, are designed with a low or no cash. Term has no cash. And you're maximizing death benefit protection. That's the purpose. And again, that's fine. If that's your goal, if you have those death benefit protection needs, by all means, take care of those, and we can help you with that. But that's not what I'm here today to discuss. Think of the teeter-totter, flip it the other way. Maximize the cash, minimize the death benefit. There's something called the Modified Endowment Contract. It's a tax rule known as the MEC, M-E-C. You can look it up online. It's been around for decades. And the MEC rule is what determines how much cash can be contributed in one of these contracts and remain income tax-free, growth and excess. There's a wide range of what can be done. This is another thing. This is an exciting thing that's developed, enhancements in terms of the tools. The tools have been enhanced to increase the amount of cash that we can put into one of these things and still be what's called a non-MEC. That's the technical term. And what a non-MEC is it's not a modified endowment contract. And what that means is the money grows income tax-free in the contract, and if you access it through policy loans correctly, as we teach, you can access the funds income tax-free. Folks, you access funds from these things, there's no 1099 issued. There's no tax paid. There's nowhere on the IRS tax forms, the 1040 form or anywhere else for loan proceeds or death benefit proceeds, because you're taking an advance on the death benefit is what it is. The death benefit's the collateral for the loan, okay? It's really not that complicated. Again, some people try to make it out to be, but it's not. You have an asset, it's guaranteed and insured, grows, and you have access to the funds. Why is this so important? It's real simple. Most investments out there, I think we can all agree, are designed primarily to grow money for retirement. Long-term growth for retirement. That's primarily the goal for most people, right? Well, this does that too. You can be a passive investor, put money away, let it grow safely, it's tax favored, all that good stuff, and you'll have a chunk of money for retirement. You also have a death benefit protection if something happened prematurely, and a long-term care benefit, okay? Those are all good things. But what I find is I have active investors. Not all of my clients are, but there's some who own businesses and do different things, and they're investors, and they actively operate their money. Or I run into people, so they're looking at opportunities, right? Invest in other things. Or, stuff happens. You get the situations where somebody has, hey, I wasn't planning on it, I got an emergency. Gosh, does that ever happen? Well, you have access to your funds. You can use them and still earn interest on the money while you're using them and not forfeit the long-term compound growth for retirement. When you put the two together, completely super powerful. In the next segment, I'm going to talk about how you can front load these contracts and still have income tax-free growth, income tax-free access, and fall under the guidelines, the MEC guidelines. We can show you how to do that. It's really exciting. You're listening to the Your Personal Bank show on Money Radio. Contact us at yourpersonalbank.com for more information.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We're going to talk about positive arbitrage. Now, this is interesting. For those of you that don't know what positive arbitrage is it's basically if you have money that you're earning more than what you're paying for it. So if you borrow some money, you access the funds, there's a cost to access the funds, okay? You're leveraging money in essence, and your return is greater than what you're paying for it. Some people get a little nervous about it. Well, gosh, most people leverage money without realizing it. Have you ever bought a house? Do you have a mortgage on it? If you have a mortgage, you've leveraged real estate. In other words, let's say you put 20% down. Let's say you have a $500,000 house and you put $100,000 down and you borrowed the remainder, the 80% or $400,000. What happens? You've leveraged. You're taking money from somewhere else. Now, you have interest on that, borrowing costs, right? Well, you're planning on making more than the costs of borrowing, so it's a positive arbitrage. Business people and investors do this all the time. Business people in particular will borrow money to invest in their business to enhance the growth or returns on their business and get a greater return on their money than the cost of borrowing it was. Okay, so it's done very commonly, much more commonly than most people realize. Okay, what most people don't do is they don't leverage or get a positive arbitrage with their investments because, most situations out there is considered too risky. Now, there are situations out there I know where you can do those things, okay, but a lot of people look at it as being too risky, okay, and there is risk involved, no question with that, but with the personal bank, you can actually create a positive arbitrage situation on your money without risk of loss. How does that work? Well, first of all, you got to understand what options are available. First of all, you have three primary options available in terms of the personal bank tool and what you can use. The first is the fixed. Fixed has guaranteed returns. It's guaranteed and insured. It's consistent. It's the steady Eddie. So currently, well, I'll go into that in a minute. You get the fixed. The second one is the index. The index is typically based on the S&P 500 index. It can be based on others. The key to it is the principal is guaranteed. It's downside protected, the market risk. So you're not going to lose. So in a year where the market goes down, you don't lose. Index annuities work the same way. It's in the index strategy, if you will. So if you're familiar with an index annuity, you're familiar with how an index life would work. Okay? It's the same process. You're going to get credited whatever the returns are, say based on the S&P 500. Now, depending on strategies have different rates and caps. What do I mean by that? Well, there can be fees, caps, and rates. Well, and whether you're talking about a fixed index annuity or index universal life, those are the two most common areas we run into it. There's three moving parts: caps, rates, and fees. What are those? And if you want to get a pencil out and jot it down, if you're looking at one of those or ever looked at one of those or have one and want to understand how your index product works, whether annuity or life, it's really simple. Again, people try to make it complicated. What's the cap? What's the rate? What's the fee? Those are the three questions you should ask. Cap, rate, fee. Cap, rate, fee. Just keep that in mind. The cap is what? Typically, it's an annual cap. Sometimes you get other options like monthly cap or biannual, 2-year caps, whatever. But the cap is how much you can make in a year, up to the cap. Okay? So in the index universal world, you usually have double-digit annual caps. 11, 12% is common these days. It varies depending on what's going on in the market. What does that mean? If you got an 11 or 12% cap, it means that if the market goes up, your index, let's say it's the S&P 500, goes up, 14%, and you have a 12% cap, you'll get 12. You'll get everything up to the cap, but not above. Okay, it's pretty simple. This next one is rate. The participation rate is what it's called. Rates are what participation rate do you get of that index. So if it's the S&P 500 index and you have most of them I see and deal with have 100% participation. There's others that don't. But if you have 100% participation and the index goes up 10%, you get 10%. If you have a 50% participation, for example, and the market went up 10, you would get 5, right? So it's important to understand what your participation rate is. Higher the better. Obviously, understand what your caps are. Again, higher the better. The last one's fees. Most of us understand fees. What's the fee? Is there a cost? Is there a fee? And in those cases, the lower the better. So you want a high cap, high participation rate, and low or no fee index strategy. Okay? It's the combination of the three moving parts that's important. So you can find no-fee products with lower caps or participation rates. You can find higher caps and participation rates with fees, okay, which is important to you. Also, to make it more interesting, you can allocate certain percentages of the dollars in different strategies. What do I mean by that? Well, some can be, for example, you can have a no-fee, lower cap index. Part of the money there. Why'd you do that? Well, no fees. So if you're expecting the markets to go up, but or not tremendously so, lesser than average returns, let's say, not spectacular returns, that's a good strategy because no fee, if the market only goes up 3 or 4%, you get it, if you know what I'm saying. If you are more bullish and you feel like the markets are going to have stronger upsides, then having a 1 or 2% fee, let's say, but having an unlimited cap is the better way to go. The first, say, 2% fee, the first 2% are taken, but you get everything beyond that. So if the market went up 20%, you would get 18 in that example, okay? So what a lot of people do is they're not, hey, can we predict what the market's going to do next year, the year after that, and so on? Typically not. I mean, we can guesstimate, but one of my jokes is, well, we'll know where the market's going to be next year. So, which is true. So why not mix it up? Put some in the low fee, or I should say no fee, lower cap, and some of the money in the low fee, higher cap, or unlimited cap, no cap, right? So you're getting the best of both worlds is what I'm trying to say. Now the last part, so remember, we talked about the fix. That's your steady Eddie, consistent. Right now those are typically 5-6% consistently every year. No questions asked. That's what you get paid, basically. There's 4% contractual minimums and stuff like that. But the bottom line is expect 5 or 6 is about what you can expect, depending on the product and the tool these days. Every year, consistent, steady Eddie. You've got the index products that are based on an index, typically S&P 500. You can get upside gains. You can get double-digit returns on good market years. You won't lose on the bad years, depending on how you mix it up. You probably, historically, last 20-year averages on those, by the way, are usually around 6.5, 7. That's the actual returns, irregardless of company, pretty much, or product. That's where they're getting. So if somebody tries to tell you something crazy or outlandish out there, probably not accurate. Be happy to take a look at it for you. Contact us at yourpersonalbank.com. Okay? The last one's the leveraged option. And basically, for your higher income earners, your higher flyers, if you will, I like to call them, and leveraging is not something that's uncomfortable. Do it normally with business and such anyway. A lot of executive bonus plans are structured this way. That's a great tool. And what is it? Basically, you're partnering with a lender, and you're typically investing the same as in the index strategy. You can get double-digit returns on market years, no loss in the down years. The principal is guaranteed. And bottom line is the lender's contributing 3 for 1. They're contributing $3 for every dollar you contribute. Later on down the road, they pull out their portion plus a set interest rate that they charge. You know what it is up front. And most cases, you're going to have quite a bit more money in your cash account, cash growing tax favored for you than you would if you just did it yourself. Because there's so much more, 4 times the money dumping in up front, if you know what I'm saying. All that's important, I don't want to like in a whole lot of detail with people, but understand you got a fixed option, guaranteed, steady Eddie. You've got an index option, double-digit returns in good years, no loss in bad years, and you have a leverage option where you can create an index with enhancing those returns of the 3 for 1 with the lender. So you can really turbocharge all that. In the next segment, I'm going to share with why understanding these 3 types of options are so important to create that positive arbitrage. You are listening to Your Personal Bank Show on 1510 AM or 105.3 FM. Contact us at yourpersonalbank.com for more information.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to Your Personal Bank Show. We have been covering the 3 types of tools that you can use for your personal bank. 1, fixed. 2, index. 3, leveraged. Now, the 3 types vary in how they operate. The end result's the same. You can access the funds, you can grow it tax favored, all that good stuff. But in terms of how the monies are credited, how it grows varies based on whether you choose the fixed, the guaranteed steady eddy. You choose the index, typically based on an index like the S&P 500 that gives you double-digit returns on good market years with no losses on the bad years because the principal is guaranteed, no downside risk. Or the leverage option where you're partnering with a lender and they're contributing much more money, 3-to-1 ratio typically. So you have a whole lot more money in there. Even when they pull out and take their portion with some interest, you still have more money in it than if you'd done it by yourself. Now, in the fixed and index options in particular, you have a positive arbitrage situation that can be created in terms of when you access the funds. Like I said, all of these personal bank contracts, all of these are designed long-term to grow money for retirement like most investments are. And that's the primary focus of most investors when they're investing money because you're putting away long-term for retirement. And these all will do that, okay? And they'll do it with some additional benefits, guarantees, downside protection, tax favored. You got a death benefit. You got a long-term care benefit built in for no additional cost. That's huge, by the way, folks. Powerful. But what I want you to understand is the positive arbitrage now. Because why is that important? Or the potential for that? And here's why. We have needs for money in the shorter term. It's very commonly we do, whether it be an emergency or an opportunity, right? So when those situations occur, or we want to use the money or need to use the money, we want to pay off some bills, we see an opportunity, whatever it is, that's life, folks, okay? When those things happen, we can access the funds from these. What happens if you compare the personal bank to any other investment out there, basically, if you take money out of an investment account, what is the future growth of that money you took out? You have a $100,000 account, you take out $100,000, what's the account worth next year? Zero. You spent it. You took the money. Your growth, your compound interest, your future, gone. It's not going to go anymore. Now, what did you do with $100,000? That's a different topic. But here's the thing. Could you take the money here and still earn interest on it for the future, for retirement? And the answer is yes. Can you also make money on that money while it's being allocated elsewhere? And again, the answer is yes, it can happen. And here's how and why. First of all, I'm going to stick with, remember, this positive arbitrage situation is available both in the fixed and the index options. I'm going to use the fixed for our example purposes because in the index option, we don't know what the S&P 500 is going to do next year. We don't know what the index is going to credit next year. We know you're not going to go backwards. You're not going to have a negative because your principal guaranteed. We don't know what the upside is going to be. It depends on how much your cap, rate, and fee is. I talked about that in the last segment. Typically, you can get a double-digit return in the good years. Okay, and those will average 6-7% historically over the last 20, irregardless of company or product. The thing is, we can't predict what it's going to be year to year, so I don't want to use that as an example. But the fixed we can, because why? Well, first of all, the fixed has a contractual minimum guarantee of 4%. We know that's going to happen, and the current rate is 5% in one of the favorite products and tools we're using right now. Now, there's others that offer more, 6+, but what you'll find, interestingly, is when we run the comparisons, run the illustrations on the cash values, the ones with the higher crediting have higher fees, so you have less cash. 6 sounds better than 5, but yet you have more cash with the 5 than the 6 because the fees were higher. Make sense? And if you have one of those, contact us at yourpersonalbank.com or toll-free 866-515-6280. We'll be happy to run an apples-to-apples comparison and show you. It's interesting when you do this. We do it all the time. But on the fixed, let's say currently it's 5. That's the best one going right now that I'm aware of. And you have an option of accessing the funds, and there's going to be a cost for the loan, the policy loan, which on the fixed is currently 5. Oh, by the way, it's contractually guaranteed at 5. They can't charge you more than the fixed rate. So worst case scenario, the cost of the money is at 5%. You're currently getting paid 5%, so what's the cost? Now, if you don't pay it back, to be fair, there's a half-point loan fee, so the cost is basically 0.5% currently. But what'd you do with the money? If you paid off debt at more than half a point, you come out ahead. If you invest in something or invest in an opportunity to make more than half a point annually, you're ahead of the ball game, aren't you? So one of the problems I talked about earlier is I think it was last week I talked about people looking at their money in a vacuum, okay? Looking at the investment money only and not considering what the costs are, debt they may have personally or through their business. And if you add that, it's the combination of the two that create your total return on your money. Okay, you've got to look at both. Here's the thing: there's a variable, the fixed. I already shared. Paying 5, they'll charge you 5. If you don't pay it back, there's a 0.5% loan fee, so it costs you basically a half point. But there's a variable option. Now, the variable option is based on the Moody's average bond index, which currently is 3.41 as we speak. That changes. But right now, if you were to do that, you're getting credited 5 on your money. You take it, pay off a bill, invest in an opportunity, whatever, and the cost of the money is 3.41. You're getting credited 5, you're getting charged 3.4. What's the difference? 1.6. That's called positive arbitrage, folks. You would actually net the 1.6 difference. Now, there's some other things involved with the account. You'd have to run an illustration, show all the factors, understand. But in terms of your crediting, you'd have a positive arbitrage of 1.6% currently. That's powerful. Because what did you do with the money? Did you invest in an opportunity to make more? I hope so. Did you pay off some bills and get rid of some debt, interest? Gosh, I hope so. My point is, if you paid off a bill and let's say you were paying 5% interest on it, well, you got rid of 5%, means you're not paying it anymore, right? Isn't that just like earning 5%? And if you add the positive arbitrage on it, that would be 6.4 difference, net swing to the positive, right? If your interest on your debt was 10%, you're now looking at 11.4, a net positive swing on your money. Does that make sense? Whether you're paying off a debt or investing in investment made 10%, it'd be the same thing, or 5%, whatever. Whatever you made on your investment or paid off on your debt, you add to whatever your positive arbitrage, and it's the combined benefit of the two gives you the positive swing on your money overall. All of your money, not just your investment account, not just your debt, all of your money, the whole picture. This gets exciting. Now, here's the last piece. Somebody will say, well, okay, that's exciting, but what if the variable loan rate changes? It's based on the Moody's. That changes. We all understand that. When you take the funds from these, you can choose the fixed or the variable option. Obviously, I'd recommend whichever is cheaper at that time. Right now, it's the variable. And they'll lock that in for a year. So it doesn't change for you. So if you lock in at 341, you're at 341 for the next 12 months. And then you get the opportunity each year to change it. You can switch between the fixed or the variable in the future. So if the Moody's rate changes, let's say it goes up, and now the variable costs more than the fixed, guess what? You change it. Now, you could pay off the loan at that time if you had the capability, or you're pretty much at a wash, you're earning 5, getting charged 5, for example. Okay, I'm fine. Let me give you an analogy. Gosh, I'm going to tell you, this is a game changer. It's exciting because it'd be like, let's say you had a mortgage on your house and you have an interest rate on your loan. And we all know you can choose fixed or variable loan rates. And today, fixed rates are really low, so most people are choosing fixed, as they should. Lock in a long-term low rate. But what if every year you could choose which rate, the variable or the fixed, and change it back and forth each year to whichever was lower? That would be powerful in terms of your mortgage, wouldn't it, long term? You would end up paying less interest overall, wouldn't you? Most likely. This is what I'm talking about. I'll go into this further in the next segment. You're listening to Your Personal Bank Show, and contact us at yourpersonalbank.com for more information.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We're rounding third, and we have been talking about an exciting topic, positive arbitrage. Now, it's kind of an advanced concept for some people, but as you start to realize it's actually not that complicated, and folks are doing it, they're leveraging money all the time, whether, if you buy a property, a house, and you put some money down and you borrow the rest, you're leveraging your money on that purchase. If you have a business and you borrow money to invest in your business to make more, you're leveraging money. And the key is the cost of borrowing the money less than what you're earning? And if it is, you have what's called a positive arbitrage. It's done all the time. It's commonly done. And you can do it with your investments, but you can do it safely. So you can do it through fixed or index options. Both are, the principal is guaranteed. Your downside's protected. So you don't have to worry about things going backwards. And on the fixed, your gains, your returns are consistent and guaranteed. So you know what on the fixed option, you can know going forward what it's going to be. Here's the key. Like I said, with your personal bank concept, you're building money long-term for the future, retirement, those kinds of things. That's the main long-term goal for most people. But you also have access to funds, which, gosh, most of us, at some point in our lives, there are periods of time in our lives, we have a need for money, or we have an opportunity that presents itself. We'd like to be able to access money to be able to invest in that opportunity, and we are unable to because the monies we've been putting away for the long term, either one, have tax consequences, penalties, or at the very least, if we take it out, it stops growing, so it kills our future, kills our retirement, right? So we're hesitant or reluctant to take the money from those sources, which I understand, to take advantage of those opportunities when they present themselves, or when we have an emergency and we just have to have the money because we've lost an income, there's a medical situation or the economy or whatever it is, we take it out of those accounts at our peril and we get slammed. I run into clients all the time talking to them about 08, 09 periods where their business, their jobs, whatever, and they had to dip into IRAs and 401ks, for example, and they weren't 59 and a half. So guess what? They paid the tax, they paid the penalty, and they slaughtered their retirement. But they had no choice. They needed the money to live. It was either that or lose their house, for example. Okay? So stuff is real. This is real life, and it happens. Okay? What I want you to understand is you have the opportunity to access funds from these accounts. You can take the monies, and you have a fixed loan option, you have a variable loan option, and on the fixed account, because we know the numbers, you can have a positive arbitrage situation. And here's the beauty. You can take a fixed loan or a variable loan, and you can change that back and forth after a year, and it's the rate you're getting charged is locked in 12 months at a time. So 12 months later, right now, if you take the variable loan option, which is 3.41, and you're getting credited 5, you've got about a 1.6% positive arbitrage. What does that mean? You take 10 grand from the account, you go pay a bill off that was costing you 10% interest, you stop paying the 10% interest, right? Because you paid the bill off. And you earn 1.6% approximately on the 10 grand. So you're still moving forward, and your money's still compounding in the account. Because why? You didn't withdraw the money. You didn't remove the funds. You borrowed them, and your collateral from it was the death benefit. That's the collateral for the loan. Okay? So your cash is still in the account. It's still getting credit. It's still earning. It's still growing. So you still get compound interest, which is powerful over time. You don't lose that benefit for the long term. That's awesome. Have monies for the short term. It can still grow in the short term, and you gain the long-term compound interest on it. And again, with the variable loan versus the fixed, you can change that back and forth every year. So if because I was going to say the variable sounds great, I take the 3-4, but what if the rate changes in the future? No problem. You change it to the fixed, whichever's lower. Again, the analogy I like to use is you have a mortgage. We all know if you have a mortgage, you can take a fixed or variable loan rate. And back in the day when interest rates were crazy, a lot of people took the variable rates. Today, when the interest rates are low, they're taking the fixed, and they should. My point is this. What if you had a mortgage 30-year mortgage, but every year you could choose between the fixed and the variable rate, and you could switch it back and forth every year, whichever rate was lower. Would you pay less interest? Over time, would you pay less interest than if you had one or the other? And the answer is most likely yes. Because depending on the years and what's going on in the economy and all that, again, can you predict the next 30 years if you have a 30-year mortgage? Where interest rates are going to be each year of those 30 years? No, it's impossible. But what if you could choose whichever's lower each year, and that's the interest rate, therefore your payment would be adjusted accordingly. Overall, it'd be lower overall, almost guaranteed. Now, I can't say that, but pretty much very high likelihood. How's that? My point is, you would have the option of the lower cost. You have that here. You can access the monies and choose the lower cost option. And if the lower cost option, like right now, is the variable rate at 3.41, okay, and you're getting credited 5, what does that mean? Your money's growing. And you took the money and you used it elsewhere to, again, invest in an opportunity or pay off a bill. You make more overall. It's like I talked about last week. Stop looking at your money in a vacuum. Stop looking at, I see this as a mistake a lot of investors make. They look at their investment accounts only and don't come into consideration like things like debt and bills and other things. They don't look at the whole picture. And the reality is if you have debt, you're carrying interest, it's reducing your overall return on your investments, isn't it? It's dragging it down. The personal bank can help eliminate that stuff and still make money on it. And what will end up happening overall? You'll make more. So if you want to have more control of your money, you want to make more money, you need to consider your personal bank as an option as part of one of your financial tools. See, the thing is, what I find, most cases, most people don't have this tool, and they're going through life, their financial life, missing a tool. It'd be like being a carpenter, and you have all the tools except one primary tool you're missing. Okay? Are you going to be as efficient? You're missing a hammer. You're a carpenter. Can you still build stuff? Yeah, you got saws and other things, but are you missing a tool? Yes. Will you get as far in life financially with or without that tool in your tool chest, in your tool belt, if you will? No, most likely you won't. In other words, again, people look at their money in a vacuum, and that's the other. And I guess what I'll talk about next week is another big mistake, very common mistake made by investors, and that is they don't diversify enough. I had an extreme example this last week. I was talking to a person who was an employee of a company, a very good company, well paid. She, of course, gets her salary from the company. She gets a purchase employee stock, and her 401k is with the company. Is there diversification there? Some people may say so. My opinion, no. Everything was wrapped up. All our eggs were in one basket. It's almost like saying, if somebody said to you, should you buy one stock? I mean, if somebody recommended that, what would be your response? You're crazy, okay? We know that. You wouldn't do that, okay? In essence, that's what she was doing. Everything was wrapped up with that company. All of her money, all of her income, all of her assets was wrapped up or tied up with that company. I said to her, and she was overfunding her 401k and everything else. I said, what if you took some of that overfunding? Yeah, get the company match by all means. Get the match, get the free money. But don't do the excess. The excess, why not put it into something else, something that has nothing to do with that company? And she's starting a personal bank because she understands tax favor benefits, cash growth, long-term care benefit, death benefit. But most importantly of all, and the last thought I'll leave you with, is the money grows. You have access to the money. You grow it long-term for retirement, but have access in the meantime. And you have the potential, through positive arbitrage, to even make money on that money while you're accessing it in the short term. What does that mean? More money over your lifetime, period. Tune in every Tuesday at noon for Your Personal Bank Show. Contact us at yourpersonalbank.com. We'd love to sit down with you and share with you how this could work for you. Or call us 866-515-6280. And listen to Money Radio 1510 AM or 105.3 FM.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.